And so next guy is Mr. Earl Klein. I met him at a Slurria meeting, about 4 months ago?
July.
So
whenever that was. So.
He presented, and I was like, how do I not know this guy yet? So Salt Lake Real Estate Investment Association. I just call them all RIAs because it speeds up the process. We got Utah Valley RIA, UV RIA. Yeah. Go out to Oregon for that, and then Slurria and Utah RIA are also in this complex, and they're pretty established. But we had the lunch out at Joe Morley's barbecue and talked about his experience, and he's in the like 70 to 80,000 doors area, so it's just astronomical. And the thing that I liked the most, that really impressed me, was there was a wholesaler that was pushing around a deal that was up in Idaho that just looked like it was too expensive. It was like, thanks for sending that, and I was done. And he actually went through and showed how he could make money on a value add, and so it was pretty cool. So,
all right.
Time over to you.
Thanks, Roger. So I sense that most of you guys are fairly new. And I'm going to try not to get too complicated with anything. If you guys have some questions as I'm going through this, you guys are welcome to raise your hand, stop me, or whatever. I'm going to take a little bit of time and talk about picking a market, right? Anybody tried to do a deal in Salt Lake City lately? Right? And I see the laughs, right? Oh my gosh, it's a difficult market, right? And sometimes you should just stay where you're at, and we're going to talk about the difference between the market here is telling us to do a certain thing, right? And if that's not what you want to do, this is a value play market, okay? Pure and simple. If you're trying to do anything other than value play, you're making a huge mistake in Salt Lake City. But there's still value plays. We just put 29 units under contract up in Salt Lake. So there's still value play opportunities here. But you're not finding 9 caps, and you're not finding 15% cash on cash or whatever. You got to go to, maybe it's the Midwest, but we're going to talk a little bit about some of the characteristics that determine those types of markets for you. A little bit about me. I've been involved in real estate for a long, long time. The truth is, I was about 6 years old when my dad put me in this pickup truck and took me out to help build houses and finish cement and stuff like that. So I've been around a long, long time. I graduated in 94 actually, but I took off and went to do an internship down in California in 91. Had been a residential realtor before that since about 85. I joke with people. I've been around as a realtor long enough to remember when the MLS was these phone book size books that came out every other week, right? And so that really dates me a little bit. And people, they're like, yeah, you can tell that I have earned every bit of the lack of hair that I have, as well as all the gray in my beard, I guarantee you. And anytime I talk real estate, I'm happy to share that with people that I've earned my stripes in real estate, except when my kids are around. And I make sure to tell them that prior to having those kids, I had all my hair, and it was all black back then. So try to see if I can make them feel guilty about they really don't care. So anyway. We're going to talk a little bit about emerging markets, right? If you deal with stockbrokers, they all want to find, hey, let's go find the next China, right? That was an emerging market 15, 20 years ago or whatever. And there's some keys to looking to those. I want to talk for a minute about the market cycle, okay? So we have various cycles. Down at the bottom here, we have what's called the buyer's market phase 2, okay? You can start over here, buyer's market phase 1. This is obviously as you top out over here, and as you start to come down in this market cycle, it starts to become a buyer's market. When you're on the way up here, it's a seller's market. What kind of market are we in right now? Definitely a seller's market, right? We're struggling to find deals, and we're struggling to find deals that make sense, okay? Give you some characteristics. When seller's market, when do you think we made the transition here? 2008, 2009, something like that, when it started to pick up again. It's been a long time. And you see supply of apartments start to dwindle. Properties start selling faster. Time on the market gets lower and lower. Unemployment has been very, very low. We've been really lucky in Utah because even in 2006 or 2007, the rest of the country had unemployment rates of 10, 12%. And I don't think we ever hit more than 7. And that was only for a couple of quarters, and it started coming back down again. So we've been really, really lucky. I think our unemployment rate's it's less than 3. And pardon?
2.9 I read on a report this week.
Yeah. And so the static unemployment is about 6%. If you're in a normal market, it's about 6. And that tells you how really low we are. Property prices going up, rents are going up, right? Demand at its highest point. So this is your seller's market, the beginning of seller's market. Okay? By the time you get up there pretty close to the top, things start slowing down a little bit. Your time on market increases a little bit, right? Supply increases. Anybody residential realtors? Are your houses starting to take a little longer to sell?
A little bit, yeah.
Just a little bit. You can see that we're up a little. I don't think we're there yet, completely, but you can see the trend, right? We can see prices got so expensive that people are having a harder time just snapping up everything. Sellers are waiting a little longer, but they're still getting what they're asking, right? It's just taking longer to find the right buyer. Inflated prices. Your construction pipeline's pretty high. We see new apartments and condos going up everywhere. And business growth begins to slow, and we're not seeing that in Salt Lake right now. So we're not sure where we are in here. There's some signs that say we're a little further up along here, and some signs say we're really down here. And buyers.
Are you just referring to Salt Lake area, or is it kind of this whole corridor?
Yeah, Wasatch Front. I think I look at Salt Lake statistics, but you really have to include the Provo area. You have to include Ogden and everything. When you're talking about market areas, it's really the Wasatch Front is really what's most people are going by. Buyer's market. This is when prices start to the market's oversupplied. Prices and rents start to fall. Anybody in real estate in 2006 that remembers it? Okay, you know what I'm talking about, right? I've seen probably 4 of them in my career. Okay, you'd think I'd be an expert, and you'd think I'd know to get out of the market in time. Literally, that's why I went back to school. Okay, I watched my dad, and every builder at the time built. They came out of a recession. They built a house. They scraped together whatever money they had. They built one house, right? Next year, they built 2 houses, and then they built 8, and then they built 24. And about the time they were at 50 houses a year, the market crashed. And these guys, and every builder, my dad was no exception, right? They're hanging out there. I think the last cycle that Dad did anything in, they had over 200 lots unsold and about 50 spec homes. So Dad took a massive crash, and just said. So I said, I got to figure out how to understand market cycles. And I literally went back to university and got my degree, hoping that I didn't figure out market cycles, but I did get some skills and things like that helped make sense out of it for me. So, and then you've got your buyer's market phase 2, which is really down here at the bottom. And this is just, we're at the bottom of the market, right? And we're just getting ready for things to start to transition. And sometimes they stay down there for a while. This last one, if you're in California, they called it the dish, right? It was flat for probably 2 to 3 years. Salt Lake didn't stay flat quite as long because, again, our unemployment rate was so low relative to everywhere else in the country. So this is a chart from IRR, and one of the advisor firms. They've done kind of the same thing, right? This would be your seller's market phase 2, right? This is your buyer's market phase 1, and then this is phase 2, right? So So anyway, this takes a lot of the national markets and tries to pinpoint where they are. And I told you it's a little difficult to tell where we are, but they've got us still right here, right? This is Salt Lake City right over here, and they've got us still in that expansion. We're not in the hypersupply where too much building is taking place and prices start to come down. There's several markets, including Denver. You talked about how Denver's not what it used to be, right? That's why. And then, you know, some of the Midwest markets that are down in here. Interesting to look at. One of the things when we talk about emerging markets, and I do with my students, I spend a lot of time talking about the market cap rates and that type of thing. One of the rules of thumb that I use, okay, is that you should never invest in a market where your market interest rate is higher than the market cap rate. Okay, there's some exceptions. If you want to do an extreme value play, you can do that. But for the most part, if I tell people all the time, the fastest way to go broke, I know, is to borrow money at 5% and invest it at 4%. Okay, yeah, you think about that. And so when cap rates are 4 and market interest rates are 5, okay, you should be very cautious about staying in that market. But beyond that, right? If your cap rates, and anybody know what Salt Lake cap rates are right now? They're right about 5.2. Okay, just barely above interest rates today. They were at 5 for a while. I think they've dropped to about 4.5.
About a year ago, we were into the 5s, but we're right in the low 4s.
Okay, so they've come back down again quite a bit, which means that it frees up a little more money to be able to do a deal in Salt Lake. But I'm still looking at cap rates. If my cap rates are much below 5, I'm a little nervous. Okay, but those are. If your market cap rate is 5, this is a pure value play market. You cannot borrow money at 5, turn around and invest it at 5, and plan on having a bunch of cash flow coming off there. It just doesn't exist. So the only way you're going to get a return is to make those go up in value, and that's what that value play is about. As a side note, to make that work, you need about $200 a month rent increase to make a value play market work. Between 6 and 8 cap rates, I call that a tweener market. It's not quite enough to get you, a 12, 15% cash on cash return. So you're still going to have to do a little bit of a value play, and that's roughly $100 a month. Okay, if you're investing in those markets, if you're between 8 and 10, it's a cash flow market. Those you can invest your own money, and you'll get a high enough cash on cash to be able to get a reasonable return. Usually you can't syndicate 10% and below, because when I syndicate, you guys put up all the money, and then I give you half of the return and keep the other half of the return for me. So if I'm getting 15% cash on the deal here, and I'm giving you 7.5%, it's not quite enough to get you to do the deal. Most people are looking more like 12. I have to give my limited partners closer to 12. So those are all 10% and above. So this is just kind of an explanation of cash flows and markets and that type of thing. By the way, if you buy one in here and you add another $100 a month to it, okay, your 8 cap's probably going to end up being close to a 10 cap. And your debt coverage ratio, although it won't do you any good to get in, but when you get out of it, your debt coverage ratio will go up enough that you can refinance out of it in probably a year or so.
Question for you?
Yeah.
On the tweeners, what's some example of what you would be able to do to justify that $100? Like, would this be a carpet and paint or?
Mm-hmm. Yeah. So $5,000-$6,000 a unit is carpet, paint. Bad appliances go. You're not replacing every single appliance and stuff like that. I mean, to be honest with you, most of the time for $100 a month, I get $100 a month just without doing anything other than replacing bad management. Okay, the owner was stupid, for lack of a better term, right? And he just wasn't watching the market. And I can walk in and raise around $100 a month. Sometimes it's the reason you say carpet and paint is because most of them are not taking care of the properties well enough, and so you end up putting quite a bit of you end up putting quite a bit of money into them that way. Somebody asked a question about value play, and I think I'm going to take a second because we just talked about cap rates, and I'm going to show you a really simple concept about value play. Oops. Boy, we went way far ahead. So if your market cap rate, so let's start with something real basic. NOI, which is your net operating income before your mortgage, divided by a cap rate, whatever the market cap rate is going to give you the value, right? So if I raise my rent $1 per month, NOI is an annual number, so it's really 12, right? And let's say I divide that by 0.08, so it's an 8 cap. You can do that on your phone if you want to, so you don't believe me or whatever, but that's $150 a month, okay?
$50 of value.
Of added value, not $150 a month, it's $150 of added value to come into an 8 cap market, okay? Same thing, 12 divided by 0.06, so now we're in a 6 cap market. This is a tweener market, right? The math says it's worth $200. Okay, the reason value plays work so well in this market is because the 12 divided by 0.05 equals 240. Okay, so if you're in this market here, what are you doing? You're raising your rent a little bit, and but if you're going to go spend $15,000 a unit and you're going to raise your rent $200 a month, right? Do you want to do it in this market or in this market? You're going to do it in this market, right? Because your return here is $240 for every time you raise for every dollar, and up here it's only $150. So anyway, that's we talked about value plays for a second, and what you're going to find is that markets are either high appreciating markets, and high appreciating market is typically a low cap rate market. So Salt Lake's very high appreciating, right? And the cap rates are pretty low. Or they're very low appreciating markets, and they typically have very high cap rates. So if you want to find high cap rates, where are you looking? Look up here. Cleveland, St. Louis, Louisville, Columbus, Cincinnati, Indianapolis, right? And this is an interesting chart. Marcus and Millichap does this one, and you can see this is the cap rates on this side, and this is the 10-year appreciation down here. Okay, you can see that Denver over the last 10 years has been the highest appreciating market in the country. Okay, it's not the lowest cap rate though. So it's not a perfect. In a perfect world, that line would go right there, and every single property would fall in line right along that line. I use as an example, San Francisco has less appreciation, but the cap rates are really, really low versus Denver. But it's not just about, San Francisco is you can't build, there's no more land. Right? It's a peninsula. If you've been to San Francisco, every piece of land is taken. Denver, right? They had a temporary, not a shortage of houses, but the truth is you can start building all the way to Kansas City, right? There's nothing to stop the building in Denver. So this one was a temporary thing based upon they went so long without any building taking place. The market turned. All the builders had moved to a different market, and so they had a hard time. Where we hear we didn't have the same trouble because, was it 2009 probably? That's about when I saw all sorts of new houses being built. Other markets in the country didn't start building till 11 or 12. We started in 2009, and so we've had a chance to keep up with the demand. Anyway, that's why Denver was so far out, so high appreciating of a market. You look at these, all of these markets down here are generally constrained in building in some way or another. So, anyway, interesting, and it illustrates that concept again. You look for low appreciating markets, you're going to get high cap rates, which would typically be a cash flow. These are buy and hold markets. You buy them, you hold them. You don't have to worry about raising the rents. You make enough money every month to put money in your pocket. You buy in these markets down here, there's no cash flow. Sometimes these markets are going to be negative cash flow, right? If the interest rate's right here, you can see some of those are even below the interest rate, but people buy in them hoping that they continue to go up in value, right? This is House Price Index report, and this is residential, but you can see the darker, the higher the appreciation. So Idaho's the highest appreciating market in the country right now. Utah's 2 or 3, I think. I think Utah's number 2, and then Arizona. Some of these markets over here were really, really high, and they started to come down. They've already started into that buyer's market, slow down a little bit. They're not bad markets. They're not going down, but the rate of appreciation that used to be 12 is now 4.5. Okay, and as a general rule, if I draw a line right here and right down here, Appalachians on this side, Rocky Mountains on this side. If you're on the coastal side of either one of those markets, those are generally high appreciating markets. Those are generally lower cap rate markets. If you're in the middle here, okay, Rust Belt, right, flyover states, one of the guys I work with calls them flyover states. And it's because, think of the jobs that they're doing here, right? They're farming, they build tractors, right? They build tractor tires, where technology and all that kind of stuff tends to be. I use as an example, right? If you graduated from the University of Michigan, and you've got an opportunity to go work in a high-tech industry, and you got a choice of going to Cleveland, Ohio with your MBA or San Diego, right? Which one are you choosing? So, right? Anyway, so this is an interesting look at different markets. This is the chart that the map comes from, okay? And you can see there's Idaho, there's Utah. I'll tell you what I teach my students. If you're not looking to do value play, okay, I'm not looking for anything that the appreciation rate's higher than 6%, right? If I'm looking mostly, I'm sending my students mostly for tweener markets, and I'm drawing the line right here at about 2.5%, okay? If the market's not appreciating at least 2.5%, there's something fundamentally wrong with it, and I don't want to invest there, okay? If you think about it, you buy an apartment complex, it takes you about 8 to 10% appreciation just so you can sell it, right? If it's only going up 2% a year, that means I'm looking at 6-8 years just to be able to sell it and get my money back, okay? And so I'm really cautious about going in some of those lower tier markets without a really, really good reason. One of the things that I do with this, and it gives me a direction of where this market is going. So if I take this 1 year of 11.36, okay, and if I take that quarter and I want to annualize it, so I'm going to take that number and times it by 4. If you do that, it's not quite 10, right? If it was 2.5, it'd be 10, so it's about 9.5. And then I'm going to take this 60 and divide that by 5 because it's the 5-year number, right? And it comes in about 12, okay? And if you do that, well, I'll show you what it looks like, okay? So this is Idaho right here that we just talked about, right? And there's the number. Does that look like that's an emerging market? Or does it look like it's a market that's gone over the top? You see what we're doing? Okay. This one's Salt Lake City. And it's not going down as fast as Idaho is, but it's definitely, it's not an emerging market anymore. Okay. It doesn't mean it's a bad market, but it's definitely not emerging. Okay. Where this, I used the state of Mississippi, right? But you can see that your 1-year number is about 3.2. Okay, but it's the quarter times. This is the 5-year number, isn't it? This is the quarter, the 1-year number, and then this is the quarter times 4. But I look at markets and I'm going, where can I go that there's still some upside, right? This one right here is my favorite market of all the markets I deal with, and it's Albuquerque. Okay. We're going to talk a little bit about some things that are going on. This is a long-term look at, I just put 3 or 4 markets up there so you can kind of see over time. I went back to 2010 and you can kind of see, if I went back to 2006, you'd see way down here, right? And they coming back up. You can see the crash and you can see them coming back up. But why is Salt Lake City so much higher than OKC, Albuquerque, and Peoria? There's a reason I put Peoria up there, by the way, but look at come along, and then it went down. Albuquerque was really, really low. So you can see that Albuquerque was starting to be an emerging market somewhere around 2015, and right here in 2016, it really jumped up. Okay, and we're going to talk a little bit about that in a second. When you're looking at markets, there's several factors that are important for stability. If you're buying at the bottom of a recession and you're saying, hey, what kind of things should I look for? What markets should I look for? Number one, state capitals. Okay, I call it the theory of government. Washington, D.C. spends $1 to fix a road here. They hire somebody, they spend another $1 in Washington to make sure that we spend their dollar correctly, right? And we do the same thing as capitals, right? The money comes in and then it gets spread out among other counties, and we keep a big piece of it here in Salt Lake. That's why Salt Lake's usually the hotter market in Utah. There's an exception to that, by the way. Sacramento, California normally should have been the first out of the market in California. It was the last this last time. Anybody have any idea why? You remember? Pardon?
Because it was Republican-based?
California is not Republican-based, I guarantee. I guarantee you. No. They had a governor at the time, Arnold Schwarzenegger. Okay. And he was the laughingstock of several late-night programs because the state was so in so much trouble financially, they were contemplating bankruptcy. And Arnold basically went to the state workers and said, you got to work 5 days, but we're only going to pay you for 3 because that's all we can afford to pay you, right? That's why he was laughed at. But Sacramento had no money to spend. And so they were the last of the big markets in California to come about. I'm just using it as an example, right? Mostly you look at state capitals, but you got to be careful. If the state capital has no money to spend, you got to be careful. Large universities, military bases, right? If you were, do you guys remember when the big three automakers went back to Washington and asked for a handout, a loan, or whatever you want to call it? Right? So they basically laid off everybody in Detroit. I mean, all the engineers. If you're 2 years out of engineering school, you bought your first house, you're just getting started, right? And it's not like you could have gone from Ford to GM, right? Because they were in worse shape. You couldn't, Chrysler was really messed up. And so what do? You go back to school, right? You go get an MBA, and you hope and pray that the market's better when you come out. You can live on student loans. You defer your student loans. Military bases are the same thing, right? The government spends a lot of money there. Okay, you got to be careful. Military bases are the Lord giveth, and the Lord taketh away. Okay, there was, I think it was Abilene, Texas. They closed down a big military base a couple years ago and moved everybody to, is it Fort Hood in Colorado Springs. If you were in Abilene and you owned apartments, you thought the world came to an end, right? You'd like, just here, bank, just take them over. I can't make the payments anymore. Okay? If you're in Colorado Springs, I mean, you're like, oh my gosh, I should have bought 4 more this year, right? Because your rents are going up and the demand. So just be careful. Military bases, you got to make sure that they're not on a hit list somewhere, right? I love Ogden, but about every 3 or 4 years, if you've invested in Ogden, you're like, please, Lord, don't let them shut this base down, right? Because a lot of things take place up there that surround that. And then technology employers, right? If you think about our employment of what we have done, 2006, 2007, 90 to 95% of us in Salt Lake still got up and went to work every morning, right? Unemployment was 6-7%, okay? Did anybody buy houses then? Nope, especially not new ones, right? unless you were bright enough to figure out that you could buy one really, really cheap, right? But the average person didn't buy a house because they're afraid. Recessions are almost always psychological. They're not really. There's usually some fundamental things, but the truth is somebody says we're in a recession and everybody stops buying houses. Okay. What about cars? Okay, the wheels had to fall off on the freeway, or you're just going to keep driving your car, right? Today we're selling new cars like crazy, but I still had a hard time getting a table at Chili's or wherever your favorite restaurant is, right? Because everybody was still, 90% of us are still employed. We're still going out to eat, right? We're still shopping at Walmart. We're just not making big purchases, okay? But go to your kids' high school, okay? Go to, all of us, right? Some of you probably have three different technological devices here. $1,000 phone, a $1,200 iPad, right? And a laptop and a desktop at home, right? And then look at the rest of the technology, right? We're all replacing our refrigerator because we can't open the door anymore to see what's in there. We need the big Samsung, that shows us what's in there, so that when we're shopping, we can look at our refrigerator inside. Anyway, technology is what's driving our country. So, the last thing I want to kind of share with you guys today is I have a concept which is invest in the stories, not the numbers, right? So I showed you some numbers, some different markets, and give you some clues about them. Whatever the numbers say, I don't go jump in and buy something because Albuquerque, looks like it's heading up in the last quarter. Okay, I'm always looking for what's really going on. If you talk about Salt Lake City and you think of what's happening here, right? Who are the leading employers in Salt Lake City? It's almost all technology now, isn't it? Right? I mean, the corridor down here, what they call the Silicon Slopes. Yep. Universities, right? Do you know how much technology has been developed up at the University of Utah? I mean, really, really key to what was the Pixar, right? The technology for Pixar was mostly developed up there. So it's just and I shouldn't give too much credit to that school from down south, but they're doing a lot of it too. Okay, right? But so you got both of them that are 50 miles apart, and they're both doing all of this research and bringing all this technology in here, and our economy is just going off the chart. Okay, this is Albuquerque. Again, one of my favorite markets. I showed you that Albuquerque changed somewhere around 2016. Does anybody know who the leading employers are in Albuquerque?
Hill Air Force Base and
Not Hill.
Kirtland.
Kirtland.
Air Force Base and Department of Energy.
Okay. Yeah, the Department of Energy is it's Sandia National Laboratories.
Sandia National Laboratories. I grew up there, so that's why I know that.
So, and they're both military based, aren't they?
Yeah, the Sandia National Labs is on Kirtland Air Force Base.
Okay. So would it surprise you that they were one of the last markets to come out of the recession, given that we had 8 years of a Democrat in the White House? And I'm not making a political statement, okay, but we know if you've got a Republican president, he's going to spend more money on military. If you've got a Democratic president, he's going to spend more money on social programs and very, very little on military, right? So it wouldn't surprise anybody that Albuquerque was flatlining it when the rest of the states were jumping up and down, right?
So are we buying based on Trump getting another 4-year term?
Well, nobody can predict the future, so you got to be really, really careful. But at least I can go back and look at what's happened, and I can mostly explain what's happened over time. And as you get really good at that, it helps you to be able to see and make some judgments going forward. So, this was kind of a funny story. I got off the I got off an airplane. No, I was headed to the airport about 1.5 years ago. And the bus driver that picked me up at the car rental place looks at me, and I was the only one on the bus, and he's muttering about those bleeding heart liberals up in Santa Fe that are ruining our state, and just going on and on and on. And I laughed and laughed. I said, God bless the people in New Mexico. I said, because you guys typically vote Democrat, okay? And it destroys your economy. So you guys are actually voting your conscience instead of your pocketbook. So I said, congratulations to you guys. Anyway, and he wasn't thrilled about what was going on. But I was there about probably about 6 months ago, and a broker told me this. We're sitting having lunch. I was buying a property down there, and he told me, he said they for every dollar they send to Washington in New Mexico, they get $7 back. Okay, so it's heavily dependent on government spending, their whole economy. Anyway, understand what's going on, right? And I'm just giving you some things just to kind of pique your interest a little bit. But anybody know who Rochester, New York? Okay. This was, for years, my go-to market. If you wanted a 10 or a 12 cap, I sent you to Rochester. Okay? Who's the leading employer in Rochester? Kodak, right? At least they were, right? And Kodak has the distinction of they developed the digital camera, all the technology for it. They put it on the shelf because they didn't want to hurt their film sales. Okay? How'd that work out for them? Well, they used to be a Dow Jones company, and today they're not on any stock index, right? They're gone. Okay? But anyway, so there was a time when you could go buy a fourplex in Rochester for literally $15,000 for a fourplex. Okay? They took about $50,000 to fix them up. So for less than $80,000, you've got a fourplex, and they were renting for $800 a month. Figure it out, right? It's a 20-25% cash on cash or higher. It's changing a little bit, but there was a time. Rochester had a big sign outside that says, "Last one out, please turn the light out." Okay, if you're looking for cash flow and you just want to hold it, this is where you're going, right? You're going to a market that has something fundamentally wrong with it. Okay, the market, the latest one, Peoria, Illinois. Who knows anything about Peoria? What do they build there? Caterpillar Tractor is headquartered there. They have been since 1910 or something like that. So I knew about Peoria. My dad bought 2 Cat backhoes every year, right? So about every other year, the salesman here, Con Pew, I think it was, used to take Dad back to Peoria to see their latest factory and hobnob with the executives and take them out, play golf, have dinner or whatever. When I was on my mission, I actually got to go through Peoria, and I was excited as could be. You drive in, and for like 4 or 5 miles before you get into town, you see nothing but buildings on either side that are Caterpillar, right? Track hose and everything outside. And when you leave the city, it's the same thing on the other side. So Peoria came to my attention because it was literally the worst market in the country for about a year. You know, that list that I showed you of the states, if you looked at the worst market in the country for appreciation was Peoria. It's been about 3 years ago. And so I did some research. I'm like, what happened? Because the construction industry is not that bad. And I knew that Caterpillar was there. Well, it turns out that the state of Illinois is the worst state in the country for manufacturing jobs. They're making it so hard to stay there that they're pushing jobs everywhere out of Illinois. Okay, I happened to be in Chicago when I read the article about this, and I'm just laughing, going, what in the heck are they doing? So Caterpillar laid off at least 60% of their workforce in Peoria about 3 years ago. And that's what you saw is this, downward spiral. Now, me personally, I'd invest in Peoria all day long over Rochester, even though they're both markets that are going down fast. Any idea why? Anybody want to guess? Rochester's not coming back. At least Kodak's not coming back, right? There's still some technology and stuff like that, but they're looking for somebody else to come in but Caterpillar, I don't imagine that Caterpillar's going to be gone. I mean, I think they had a temporary lull. You can go in there today, you can find some 10, 12 cap properties, hold them for a few years, and I personally believe Caterpillar's going to come back. So, again, this is a census map, and when I look at big markets, and then what I tend to do is look, and this is the city of Albuquerque, by the way, and this is the airport here. Right, and this is ranked by income. You can look at if you get on the census map, you can actually dial down into this is downtown area right here. Some of it's low income, and some of it up here is pretty high income, just depending where you are. But if you're looking at you find a property, and I don't think you should look at this when you're putting a property under contract. To be honest with you, it's due diligence, right? So I go in and I make an offer on a property, and I may glance at this, but really when I dial down on this kind of stuff is when I've got it under contract and I'm thinking about, is this really going to be a good market? But there's a ton of resources out there. Anybody seen the crime heat map? Trulia does a crime map. I'll look at that, right, to see, and I look at the income levels of various census tracts. One other thing, so this is this comes right from bestplaces.net. There's our unemployment rate, population. This one is important because it tells me how many people are, if it's 20s, they're living in apartments. At 30, they're starting to try to buy houses. And may not be investing in or living in apartments. But here's an interesting statistic. And Roger and I were talking about this, 3 or 4 weeks ago? And I told him that we're still an affordable market. And he says, no, we're not anymore. So how much, for a $100,000 home, does anybody know what it takes, how much income it takes to qualify for a $100,000 loan? It's about $25,000 a year, $25,000 to $30,000, okay? So if the median home price is $100,000, this needs to be at least $25,000 a year, or the average person can't afford to buy a house. Okay, does that make sense? Right? Does that look affordable? Yeah, for this, we need to be almost $90,000 a year to be able to afford that average home price. Okay? Is that good or bad for apartments?
Good for apartments.
It might be good for apartments, right? Because that's going to push some people over, more than likely, right? And that's going to push your rents up, right? Until they build too many apartments or whatever. So anyway, this is one of the things I love to look at. Is it an affordable market?
I gotta go, I've got
Nope, not a problem. So anyway, I am done. Thank you very much for letting me come and spend a few minutes.
Thank you. You were great the last time I was at the Peoria.
So, I'll be happy to stick around, answer any questions that you have. Did it get you to think about a few things when you're thinking about markets? Does it help you explain why Utah is so difficult to do a deal today? So.